let's now have a look at the objective of IFRS 15. And you'll see the objective of IFRS 15 is stated as aiming to establish the principles that an entity shall apply to report useful information to users of financial statements about the nature, amount, timing, and uncertainty of revenue and cash flows arising from a contract with a customer. Okay, so a contract with a customer is what will drive this. So meeting the objective, we have a core principle. The entity shall recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. So what you'll note here is that the revenue is all about what we promise to give the customer, okay? And that is a obligation, a performance obligation. And in return for performing, we will receive something, right? It'll usually be cash, and we will receive this consideration. In order to do this, we will apply 5 steps to achieve this core principle and account for revenue in terms of IFRS 15. Now I've laid those 5 steps out. First, you will identify the contracts with the customer. Now that will usually be a written contract, but if it is an invoice, okay, to deliver a good, okay, guess what? That's a contract, right? Identify within that contract any performance obligations. Those are the promises that we have made to deliver any goods or services. Okay, so we are the entity and we've made promises to deliver in that contract. Step number 3 is determine the transaction price. That is not necessarily the price that's on the contract. You've got to take into account things like time value of money, variable consideration, right? There's a couple of things and we'll deal with them in detail. Then once the transaction price has been determined, you will have to allocate that transaction price to the specific performance obligations in the contract. So if there's software that's being sold along with installation, you may have to recognize 2 different or allocate the transaction price between 2 performance obligations, namely the software being the product and then the installation of the software being a service. Then you will recognize revenue when or as the entity satisfies performance obligations, and these will be satisfied either at a point in time or over a period. Right, now just when you look at the standard itself in the index, you won't see these 5 steps. So the standard talks about recognition like all other standards, as well as measurement. Let's just look which steps affect recognition and which ones affect measurement. So recognition, step 1, identify the contract, that's about recognition. Step 2, identify the performance obligation, that's about recognition. Step 3, determining the transaction price, that's all about measurement, ladies and gentlemen, as well as the allocation of that transaction price is about measurement. Then the final step, recognizing revenue when performance obligations are satisfied, again, back to recognition. Please learn these 5 steps as a good base for what we are going to work through next. Thank you.